And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is not one guest, but two special guests. I've got Sean McCurry and Paul Carroll from Pinnacle Family Advisors. Sean McCurry is president of Pinnacle Family Advisors and co-portfolio manager of Pinnacle Sherman Funds. Together they manage around $300 million. And Paul Carroll is the chief investment officer for Pinnacle Family Advisors and portfolio manager of the Pinnacle Sherman Funds. Gentlemen, welcome to the show.
Thanks for having us.
Thank you, Adam. Great to be here.
Before we dive in, I know that there's some disclaimers that I would like to read and get everything out of the way. Any opinions expressed are subject to change at any time, and they're not guaranteed and should not be considered investment advice. That's number one. Number two, there's no guarantee that any investment strategy will achieve its objective, generate profits, or avoid losses. Investors should carefully consider the investment objectives, risks, charges, and expenses of the Pinnacle Sherman Multi-Strategy Core Fund. This and other important information about the fund is contained in the prospectus, which can be obtained at pinnacledynamicfunds.com or by calling 888-985-9830. The prospectus should be read carefully before investing. The Pinnacle Sherman Multi-Strategy Core Fund is distributed by Northern Lights Distributors, LLC, member FINRA. And that is now out of the way. Welcome, gentlemen.
Thank you.
So, Sean, can you give us some background about yourself and how you got started in the business?
Sure. So rather inauspicious start, but I'll share it just because it may encourage some other men and women out there that started off kind of rough. I had the opportunity to open up the first Raymond James Financial Services branch in our city of Springfield, Missouri, with another seasoned financial advisor veteran. Basically what happened is his life sort of imploded, and I hadn't been in the industry very long, and we sort of had this shambles of a branch office left over. So long story short, they were going to close the office down, and through a series of events and some kind of courageous emails I sent at the time, because I certainly didn't have much to back them, I convinced the powers that be to continue to leave the branch open and let me kind of take over the reins of it, start to run. So I had a brother-in-law that joined me around that same time. We started to build the Raymond James branch, and lo and behold, after a really rocky start, we started to get our footing and just enjoyed a really good run there at Raymond James. So there's more stories to that. I had some money embezzled from it. It's pretty incredible, the hurdle getting to just pass that first sort of level of success, if you will. I'll never forget, we got awarded like this $15 million corporate retirement plan when we were just on fumes. We didn't have much in the way of cash in the bank. And after that was the RFP process, we had to compete against much bigger firms. When we won that, we kind of looked at each other and were like, okay, maybe we're going to make it here. So that sort of launched things. And then a few years later, still very happy with Raymond James. Paul Carroll, my good friend since we were at the age of about 18, he was with another firm. We sort of convinced Paul he was moving back to Springfield, Missouri to work with us. And through the course of that, really still very happy with Raymond James, but in order to do some of the more holistic and maybe family office oriented things, I decided to leave Raymond James and start our own registered investment advisory firm. And Paul Carroll, with the blessing of my brother-in-law who continued to run the Raymond James branch, has worked out great for him. He's had a great career there. Paul joined me, and I started that, I think, in 2008. And again, slowly but surely, we left basically all the assets at the Raymond James branch. There was kind of a buyout. So kind of started all over again, fairly much from scratch. So it's a position as an entrepreneur that I didn't mind. And I think I probably would have done a few things different, but still glad we started over with our own RIA, because over the years, and it's taken us a while to get our footing and figure out what we're really doing, but the structure of it really allows us to be creative and to do some really exciting things, both for clients and then now on the asset management side for other financial advisors who are now our clients. So I can just briefly end with saying we've kind of developed sort of three lines of business, if you will. They're separate, but we feel like they're sort of integrated, and we want to continue to execute in all three. One is just offering a platform for other financial advisors to affiliate with, so the direct wealth management side. The second is family office. We were fortunate enough to have a couple of very large families we don't really have a AUM relationship with. It's just a flat fee per month to pretty much do any and everything they need for us to do. We have a multifamily office, which we really have a couple of good sized families that are part of that. We're looking to maybe grow that one family a year. It's not something that it's not a volume business, right? And then the third, and what's really fun to work on, I think, is the asset management side. And that's really a side that Paul's just been invaluable to us on, building products that we've already used the process of with our family office clients, and to build products around those and offer those to other family advisors. So that's really what we're trying to do, trying to execute on all three and continue to grow any and every way we can, as long as it's ethically.
Wow, I love that. So quality over quantity is the point there. Is that correct?
It has been. It really has.
I love that. So Sean, I've known you guys for years, and my audience knows I'm a huge fan of you guys. So you left in 2008 and you started. Was that during the crisis, before the crisis, like before Lehman or after Lehman? Let's put it that way.
It was before. Great question. We started that technically I think we got our, registration approved maybe December 2007. So it was before. And so that was also challenging. Not that we had that much in AUM at the time to really get whacked hard by the market correction. But it makes you a little queasy that you started this, and we raised a little bit of capital for that, and you're like, okay, we got to really weather this and come through. Thankfully, that's where having some investment processes in place that protect on the downside definitely didn't just provide our clients comfort, but it provided me as an owner of the firm comfort. So
yeah, for sure. I mean, if you can navigate that environment right out of the gates, I think that speaks to, volumes to everything that you've got going on. So that's fantastic. So Paul, if you don't mind, can you just let us know a little about the investment strategies? I know you run several different strategies, and how you handle risk and so on and so forth, please.
Sure. We're obviously, our main strategy, overarching strategy, is we're very tactically oriented. So that doesn't mean that we don't believe there aren't other ways that people succeed, because the evidence shows that there are. In fact, if you have a long enough time horizon, right, as long as you stick with a strategy and it's a sound strategy and you have a long enough time horizon, usually those will play out well. What we've just found, and what I found in working with clients, is I used to always hear it. I think I heard it from someone else. I don't think I coined the term, but it's that there are truly no long-term investors, meaning when you're dealing with people in their money, no matter how much they say, oh yeah, I'm in this for the long haul, I can handle the ups and downs. That's true usually in a shorter period of time, maybe, a couple of statements. But if they get statements, as we saw, I got into the business in February of 2000.
Oh, wow.
So that's when I first got in.
There was margin high, right?
Yes. And so, and worked with another advisor. So good situation coming in with him, but he was taking a sabbatical. So this is a different, so he took a sabbatical leaving in May of 2000 for 1 year.
Wow.
And I ran his book and met with his clients, right? Becoming for that year. And that's what it really hit home, right? The first couple of months, it's, oh yeah, Scott said this could happen, that you get some down. And then as time just continued on month after month,
right,
you could just see it wearing down on them, and it didn't matter what you put in front of them. You could have all the information that you want.
Right.
It's not going to overcome just the emotional toll. And actually, it's during that, I started off with Wachovia Securities. That's who that firm was. And to their credit, one of the classes I came back to, about 8 months in, Dorsey Wright, very famous, technical oriented manager.
We've had him on the show before, people from NASDAQ, Dorsey Wright. Yeah.
That's right. So a lot of respect for them. They got one slot, like a 30-minute slot, for whatever reason, them talking about having a process and supply and demand, and that the market, there are ways to pick out kind of the bigger moves. Yes, it went off in my head, and it made sense of, okay, this is going to not just theoretically make sense, but this is something that can actually help clients, right? It's not just on paper that it's going to work out. It is. You can actually, when you're dealing with clients and talking to them, it's something that actually, and then when you put it in practice, it's something that actually helps them go along through the process. And so of course, when you're newer, when you first hear it, I'm sure many others have made the same mistake, which is, oh, this is the holy grail, and it will work every single time you implement it. And so you learn over the years, okay, there's kind of there's science part, and then there is the art, a little bit of, okay, how do you implement this? How do you put things together? And so then joining on with Sean and with Pinnacle, we obviously wanted that to be our approach. And again, because we believe that really helps the clients the most along the way. And so we've had, ever since we started off, we've had that kind of technical oriented, tactical risk management process in place. I'm also a big believer in there's many different ones out there, right? From very simple ones to much more complex. I am a believer in blending those types of strategies together, because what I've also seen over the years, as what I'm sure you have, Adam, and the listeners out there, is every strategy has its day in the sun, right?
100%.
And the little known secret, not in the industry necessarily, is advisors sometimes were as bad sometimes as clients chasing returns. Sometimes advisors on the technical side are bad about chasing strategies.
Right.
And so I learned, a while ago of, hey, there's going to be times blending the strategies together seems to make the most sense, rather than chasing the latest one. Oh, look how well this one just did. It did much better than the one I've implemented.
Right.
And so having a blend of those together, I think, has been the biggest. Sets us apart is the willingness to say, yes, we're tactically and technically oriented, but it's finding ways to blend different strategies of that together to kind of smooth out even those rides.
Got it. So my next question, Sean, I know you have a lot of services to different advisors. How do they benefit from using your different strategies? Like Paul just spoke about, some strategies do well, some strategies don't do well at times. You blend them together. So can you speak a little bit about how you can help other advisors better diversify or the different services you offer?
Yeah, great question. And we found advisors, use this in different respects in terms of their client portfolios. But one of the core sort of ways, I would say, if we were walking into an advisor's office and trying to win over some of their business, I would say there's a lot of strategic funds or things that we're not going to try to compete with. And for their clients, sort of buy and hold component of what they do, that's not necessarily where we're trying to fight to get shelf space. But I would say on the mutual fund side, for retail clients, and I say it's kind of like an everyman's hedge fund in this respect. They really get true active management. They get managers that aren't afraid to go to cash or to take money off the table based on indicators. And really, usually clients at that mid-sized level of assets, whatever you would target that, or even lower end, very often the advisors, they wouldn't publicly say this, but those assets on their books are not receiving maybe as much care. And our funds are not just for those at the lower end of the asset spectrum at all. But if we're fighting for space, we're going to say, hey, this is like an everyman's hedge fund to provide somebody that also doesn't have a performance fee, a carry fee on it. Not that there's anything wrong when they deliver alpha, but so I think that would be one place, is sort of this for lack of a better term, maybe the alternative component of a client portfolio. But man, we've seen a number of advisors that are definitely like that, being more of a core piece and using the strategic, funds or ETFs as more the satellite. So some advisors that are risk averse really like having a larger percentage, looking at our funds as more of a core holding rather than a alternative satellite. So I hope that answers your question a little bit, but that's where I would probably go for, is that everyman's hedge fund type of piece of the portfolio that they want to outsource to someone.
Yeah, that makes perfect sense. And then Paul, can you speak a little bit about risk and how you guys handle risk? Because I know a lot of advisors are concerned with that. So if they do want to move into your funds, how do you mentioned cash as a position, Sean. So Paul, if you don't mind, could you speak a little about the risk factor?
Sure. And an easy way to do that is, for instance, with the Pinnacle Sherman multi-strategy core fund, So it's really a blend of 4 model portfolios that use 4 different risk indicators. So if you think about kind of the much bigger picture that I was speaking about earlier in blending strategies together, that's where you see this played out right within this one fund. We kind of had a short-term indicator, an intermediate, longer term, and then one that really, it's a little bit, I would say it's a little like in between short and the intermediate to sometimes between the intermediate long. So it's a little more all-purpose, if you will. The blend of those worked out well. So we also don't try and overcomplicate or say, okay, if an indicator turns down, but we think something different, we're not in that situation going to override that. So to us, that would be going against the strategy, and we would be introducing unreasonable or more risk by doing that. So how we're going to attack risk, since that was your question, Adam, is saying, okay, the blend of these together are going to help smooth out the ride. And so the shortest term indicator, a great example of also what I was mentioning before about every indicator has its day in the sun, right? The last 12 months have been difficult for the shortest term indicator, but it's only 25% of the portfolio. So when it's negative, we're at 75% invested. If it's positive and everything else is positive, we're at 100%.
Right.
So it's not like we're taking, half or all the portfolio off the table just on a short-term indicator. So that also helps us. How does that help us? Well, I think sometimes also advisors in our situation that enjoy more the tactical aspect or the technical aspect or are managing the risk, sometimes we can overplay to that. That's another thing I've seen. And what I mean by that is there's always, the next shoe is always just about to drop, right? And the reality is this: if you would have asked me, maybe at the end of last March, right? End of last March, the market's gone down and it's going to pop. If you ask me, okay, can the market pop here? I think I would have said, sure.
Yeah.
Right. It's so oversold. Yes, a pop could definitely happen. But if you would have asked me then in June, when it starts kind of rolling over a little bit,
After it pops.
yes, that the pop has happened. Hey,
Right.
and everything's looking great, right? Because wasn't it looking great last year? Well, no. And how does the market continue to do what it does? And the indicators, I think, we often want to think of risk as downside, which I think that's very appropriate, and that is how clients, you need to think that way. But there's also, but protecting against that does you no good if you don't get any of the upside.
Right.
If the market's up last year like it ended up being, and if we would have only been break even but said, hey, we only took half the downside risk in the thing, well, maybe a few might have enjoyed that, but the reality is most would not have found that helpful. However, the reverse of that is true. If those indicators keep you mainly long, which they did throughout the rest of the year, even though maybe on paper it should look different, from a fundamental standpoint, but it didn't. They kept us in there. That really helped the return. So not only did we get much less downside during that March sell-off, but then we're turning around and captured a very good upside year. And so that's how we approach, that's how I think of risk, is we want to be able to not get blown out by the real bad 20, 30, 40, 50% declines, right? We want to definitely miss out on a good chunk of that, but we also don't want to do that at the expense of capturing some of the upside.
Got it. So, Sean, what are some timeless lessons you've learned that you'd like to share with the audience?
Oh, wow. Well, maybe for those sort of that think of running a business as well as a practice, clearly just keep moving. A little bit of progress every day and every week. And it's the same stuff you hear from Navy SEALs to whatever podcast you listen to. You just keep your head down and keep moving forward. But it's basic. But man, I would say there's very few things that'll win out over some level of grit and tenacity. So stay after it if you still enjoy the industry. And I think also what Paul said, you know, in an age where everyone's so partisan or their ideologies, whichever they are so entrenched, my goodness, as we get older, we actually try to stay much even more open, always looking for solutions, trying to go net neutral. If it's a deal we're after, or if it's a new investment indicator that we can include, I say being a lifelong learner, being open, being objective to wherever the data and the truth leads you is indispensable, particularly in a culture where that's pretty short on supply. If we can supply that to our clients, both to our advisors and our wealth management clients, be clear thinkers, objective, go where the data leads. I think, man, I would encourage people to stay thoughtful learners throughout life.
I love that. That's really, really great timeless advice. And how about some mistakes, or what's some timeless mistakes you've seen people make, and then how do you recommend avoiding them?
Wow, great. Another good question. So you've been doing this a while, haven't you? So I would say on the investor side, Paul spoke to that is, and you know, I know that the psychological component is a big, important part of your strategy and the things that you do. And the whole behavioral finance side of things is just, it's still, I think, not fully addressed by a lot of quant people. So I would say that people can still be extremely irrational and you better craft. I've learned that they will often, thoughtful, highly intelligent people do the absolute wrong thing at the worst time. So I think you have to be aware of that. And it's not an intelligence factor, it's just an emotion-driven factor. And then I think on a business side, this is just rudimentary, but I probably would have started off by raising a little bit more capital at the start of Pinnacle, and we fought to do very well. But from a business owner perspective, I think that there's nothing wrong with being overcapitalized if you're launching your new firm or starting something to get some strong partners along with you. If a little cash in the bank is a good thing. So
good, yeah. Don't be undercapitalized, right? Be over.
That's right.
Anything.
Yep.
I love that. So I guess the final question I have for you guys, you said you manage money for individuals, you manage money for other financial advisors, and for family offices, you offer consulting or advisory services. Mm-hmm. What is the best way for people to get in touch with you, and what are some of the ways that they can engage or work with you?
Okay. Paul, you can go ahead with that one.
Sure. I'd say, depending on what's kind of resonated with them. So if an advisor is listening and I'd like to learn more about that mutual fund, they can go to Pinnacle Dynamic Funds.com. Again, Pinnacle Dynamic Funds.com. And that's going to give them information on that as well. And then there's a way that they can send us a message right through, like most websites have, so they could get us a message that way. They can also obviously call me directly. They can reach out to me. My direct line is 417-351-2937. Again, 417-351-2937. And that is my direct line. They can reach out if they have a question like on the strategies themselves and want more information on that.
Beautiful. Well, gentlemen, thank you kindly. This has been an absolute pleasure. I definitely recommend everyone go to the website, check it out, and hopefully we'll have you guys on again soon.
Super. Thanks, Adam.
We appreciate you having us on, Adam.
Yes.
Thank you.
Thanks, guys.